Tonight we're talking about advanced Elliott wave. The concept of advanced Elliott wave can go almost indefinitely. We're going to touch on some highlights that you may not be aware of that we do use in our normal nightly analysis. Our goals for tonight are first and foremost to understand how a correction will unfold and identify its probable completion. And the reason why we're going to be focusing tonight on corrections is because with Elliott wave, the market basically goes correction, impulse, correction, impulse, correction, impulse. That's the way the market works. It does that on a fractal basis. That is, it does it on a very, very short-term time frame, literally intraday. It does it on a longer-term time frame, and it also does it on a macro time frame. So if we have a correction and we know that an impulse will follow a correction, what we want to try and do then is understand how and when a correction will unfold, how and when a correction will complete, and if an impulse is to always follow a correction, which it does, then if we can identify its probable completion, then we put ourselves in a much better position to trade the impulse that follows along very nicely. And of course, obviously the one thing we want to do without fail is trade that impulse higher. So tonight our goals are to look at corrections, understand how it will unfold. We're going to be looking at 4 different kinds of corrections. We want to try and identify its probable completion. When do we label an impulse move as a major degree wave 1 versus a intermediate or smaller degree wave 1? Well, that would depend on the size of the wave or compared to the prior wave. If the prior wave is a very large wave and we've got a smaller wave, then obviously it's going to be a minor degree pattern. So everything has to be in fractals and it all has to be in the same size. And we'll have a look at a few charts as we go along and you'll get the drift of that. The easiest way to understand where it sits in the bigger picture is to use a zigzag indicator, which we'll put on some charts a little bit later on. So, for example, if you get a stock that rallies, let's say, 100% and retraces 20%, that could probably be, within the same wave degree. But if you then get that same stock rally 20% and then retrace 5%, well, that's a different degree kind of pattern. Our exercises tonight is to identify 4 types of corrections. Now, I believe there's about 12 different types of corrections, and each one of those corrections have a different pattern. Now, this is where Elliott wave falls apart with skeptics, because one person's correction is a different person's correction. At the end of the day, it doesn't matter. A correction is a correction. Impulses are strong. They're big trends. You should be able to look at a chart and say, bang, there's an impulse. Corrections are choppy. They're nasty pieces of price action. And you should be able to look at a chart and say, bang, there's an impulse, there's a correction. The kind of correction at the end of the day doesn't matter. People who get hung up on the kind of correction and how long it will last, well, they're just looking for trouble and it's a pointless exercise. The first things you want to know, are we in an impulse or are we in a correction? That's all you want to know. So we're going to identify the 4 major types of corrections here tonight. To do that, we're going to be looking at some Fibonacci levels. We're going to be measuring retracements. We're going to be using what's called internal and alternate price projections. We're going to be looking at some time analysis, and we're going to be using some volume as well. But these are just a few of the tools you can use, and understand that we're just touching the tip of the iceberg if you really want to get into this kind of analysis. Does it make a difference to the bottom line? No, I don't think so. But some people are convinced about it. If you are, that's fine. Listen to what I have to say tonight. But understand that at the end of the day, trading profitably is very, very different to doing analysis in the 3rd degree like we're going to be doing here tonight. So there are our exercises for tonight. We're going to run through that. Don't get too concerned about the retracement levels and the time levels. We're going to be summarizing those right at the end, and I've got a spreadsheet for you that you can download, and it'll do everything for you. Okay, so another question coming in, and when you say impulse, can I assume that you're referring to an upward movement in a stock? Well, an upward movement or a downward movement doesn't matter. And you can have an impulse up, you can have an impulse down. 2008, what was it? It was impulses down. It's a strong, clean, powerful move in the stock. It doesn't matter if it's going up or down. We can have them down, we can have them up, but it's got to be strong, it's got to be clean. You look at any stock, if you see a strong, clean move, hey, that's an impulse. If you see a choppy, sideways, backwards kind of move, that's a correction. That's all we've got to know. Let's get on to the first of our 4 corrective patterns. The first one is a zigzag. Now, again, you're going to hear me saying this all tonight, so I'll apologise right now. Don't get too hung up on the technicalities, okay? It doesn't matter at the end of the day. It's the general pattern, the general shape of the pattern that is what is important, all right? So a zigzag will tend to occur at the wave 2 position. It can occur at the wave 4 position, but most of the time it will occur at the wave 2 position. Usually a zigzag occurs, it's a deep retracement, and it occurs because most people are not convinced that the trend has changed. They're looking to be a seller into the strength, and they're not convinced that the trend has actually changed, and as a result, the zigzag will tend to be deeper than a wave 4 kind of pattern or the other patterns we're going to be looking at. A lot of the rules I'm going to be talking about here tonight, they are the pure theoretical academic kind of rules, but in real life that doesn't really happen. I just want you to understand the picture on the left. I want you to grasp that picture on the left. That's what we're looking for. So what we're looking for is a very strong impulsive move, usually a wave 1 off a major low point, and we come down to an a wave B, and down to a wave C. Now there's 2 very important attributes of this pattern. First of all, wave B only goes about 50 to 68% of wave A. All right, so wave B tends to be quite short, and wave C must fall below the lows of wave A. That's the ideal pattern. If we dig a little bit deeper, usually wave B will be about 50% of wave A. It cannot retrace more than 75% of wave A. If it does retrace more than 75% of wave A, we have to start looking for another pattern, a more flatter kind of pattern. Another important attribute is that wave C, this wave down here, tends to be the same length as wave A. Now when I talk about tends to be the same length, I'm not talking about to the exact cent. What matters is that we have wave A, stunted wave B and C. So we've got this zigzag kind of pattern coming down. Shane has asked, can a zigzag be in an A, a zigzag is in A in a 5, or always can it be in a wave 3? A zigzag will tend to be in the wave 2 position. It will also tend to be in the wave A position, but it can be found in the wave 4 position. But usually what we have to talk about is the law of alternation, which means that if wave 2 is a flat pattern, which is very, very rare, then wave 4 will be a deep pattern. In this particular example, really what you should be looking for is wave 2 or a wave A as a zigzag kind of pattern, but understand the law of alternation means that if it is not a deep, then the wave 4 or C will be the deep one and will tend to be a zigzag. It doesn't have to have 5 internal waves. Well, again, according to absolute theory, if you want to read the theory, that yes, it does, but the 5 waves may be on an intraday chart and are not visible on an end-of-day chart. We only use end-of-day charts. So when we're talking on the Chartist, end-of-day charts are what you're seeing. If you want to break it down, you have to go to an intraday chart, and a lot of the time, not all the time, but most of the time, you will actually see it, whether it be on a 60-minute, a 30-minute, or a 120-minute chart, you'll actually see a 5-wave impulse down to the wave A point. Just take a couple of brief examples. So here's a nice one that I found. We've got to move up, and it's an impulse move. We've come down to a wave A. You can see we've retraced exactly to the 61.8% retracement. Everything you'll see on my Fibonacci and on the Chartist Fibonacci's, you will only see the same Fibonacci lines, 38.2%, 50%, and 61.8%. You will not see any other kinds of Fibonacci retracements at all. So you can see a wave B, as I said in the rules, will tend to retrace 50%. It's a deep retracement, but it should not retrace more than 75%. You can see here that's exactly what we've done, and then we've started lower into the wave C. So very nice ABC pattern here, and notice up here on the wave C bar, we've got a very strong close, and that there is a very good indication that this market's going to go higher, and obviously that's what exactly occurred. But here's another one in a downtrend. We've got an impulse coming down, A, B, C. You can see we've got some nice wave equality going on there. And take a look here, wave C, we've got a very low close. We tried to pop up a little bit, but didn't take out that high, and the trend continued down. So the whole point of these few slides is to understand that a zigzag pattern is this ABC, where wave B terminates at about the 50% mark of wave A and has one more leg up, and then we go again. Pattern number 2. This is a flat pattern. These are very, very common, and again, you can see these on quite a significant amount of time frames. You can see them take 7, 8, 10 days to unfold. You can see them take 2, 3, 4 months to unfold, but they're just as powerful regardless of what you see. Now, the most important things to understand with a flat pattern is that wave B will go beyond that 50% to 61.8%, and as soon as it goes up through that 61.8%, you've got to be looking for a flat pattern. So a flat pattern tends to be a shallower pattern. Wave B comes all the way back up, kind of makes a double top, and then comes back down again and tags the low here at wave A. A lot of people look at this pattern and say, gee, it's a double top, and they look for a break of wave A and they get short, but buyers tend to come in right here and prices zoom straight back up again as the shorts cover their positions. Wave B retraces 100% of wave A, that is, it goes back up to the top, and then wave C tends to be impulsive, sometimes on an intraday basis, does contain 5 waves. Don't get hung up on that on an end-of-day basis. But importantly, you can see we've got this kind of squarish pattern right here. So wave B tends to meet the whole high, wave C tends to meet the wave A, and most of the time this kind of pattern will occur in the wave 4 position rather than the wave 2 position. So a zigzag will occur in the wave 2 position, and a flat pattern will tend to occur in the wave 4 position. Remember, that can be reversed, the law of altercation. If you do see a flat pattern at wave 2, you will therefore tend to see a zigzag at the wave 4 position. So let's have a look. Here's a slightly expanded version. It's not a tight one, but it's slightly expanded. You can see that we've got a retracement down to wave A. Prices come back up, tag the old highs almost to the cent, retrace again down to the wave C, almost tag the lows here to the cent, and off we go into the next impulsive move up. So that is an absolute textbook example, and I think this is on the US Treasury bond. So again, these kinds of patterns will occur on any single market in any kind of time frame. Here's another one, wave A coming down, wave B tags those highs. Remember, that's what makes a flat pattern. Wave C comes down, just runs through the bottom of wave A for a few days, but then off we go. So that again is a flat pattern, and that is a very, very common pattern and one you should keep an eye out. In fact, it's one of my favourite patterns to trade. Let's go to a running flat. Now, a running flat, we start to get a little bit more complex and a little bit more difficult to identify in real time. The reason being, a running flat, and let's just define the pattern, wave B will run higher than the prior high. You can see there, wave B is higher, and a lot of the time when we see like an ABC pattern down to wave A and a strong move up into the wave B, we start to think that a new bull run is happening. But the giveaway is that this wave B must be a weak wave. That is, it can't be an impulse. If it is a choppy wave up, then you know we're looking for a running flat kind of pattern or some kind of a flat pattern. So wave B will run above the old high, and then wave C will run just below the wave A low. Now, the important thing here is it's difficult to define in real time, i.e. you tend to get caught out at this position right here. But where you make your money is you know, almost guaranteed, that this wave C will come below wave A by a very, very small portion. And when you start seeing bullish signs right here, it's a screaming buy. Believe me, this is a very powerful pattern. It becomes more powerful if we get divergence between the A and C. That happens occasionally. But if we've got a strong impulse and this kind of pattern, you've got to look for a buying opportunity here at wave C. Would volume be lower in B than in A? Generally speaking, volume is weak in this whole pattern. What you want to be looking at is average volume between the move up to this high right here and average volume to this B high here. If the average volume in this wave B high is lower than this one, you can be guaranteed it's going to fail and it's going to rotate lower. All right. So volume can be a very, very important indicator under the right circumstances. And tonight we're actually going to be talking about volume a little bit, not extensively, but a little bit. But absolutely volume is important. A running flat, wave B runs a little bit higher than the prior high. Wave C runs a little bit lower. Now you can get running triangles as well. We actually highlight running triangles in the Chartist occasionally, and they are also a very, very good pattern. But a running flat, just like a flat, is a very, very good trading pattern. A couple of examples. Wave B runs higher, wave C runs a little bit lower, and then off we go to the upside. Okay, so that's a running flat pattern. And here's a much tighter one. This is a very, very bullish kind of pattern right here. See how it's nice and tight. Wave B runs higher, wave C runs lower. Look at that nice high close right there. That is a very bullish bar, and off she goes to the upside. Now this kind of pattern here is a very, very powerful pattern when you find them. Use the trader's trick entry to enter that trade. You'll actually see these quite a lot in the US market. We find a lot of them in the US market. Very, very potent to trade. Question from Anthony. Given C has made a lower low from A, would the next wave be lower than the high of B or likely to run higher? Sometimes a lower low might suggest a down pattern. I understand what you're saying, Anthony, but remember we are looking at the bigger picture patterns. We are looking at corrective movements in an impulse, and as I've said before, most impulses unfold in 5-wave patterns, and we're looking at the wave 4 here. Usually, if you're looking for a downturn, what you'd want to see is what's called a lower swing high pattern. Wave B is a higher swing, breaks the low of wave. Now that's normal Dow theory kind of pattern that you read in basic textbooks, but it's not good enough in today's market environment. If you see a secondary high that is lower than the wave B and then prices break down through wave C, well then you're wrong. But whilst this kind of pattern is happening, bullish pattern. So just the fact that it's broken the wave A does not mean the market has turned bearish. We have to have that lower swing high pattern be in place and then swing lower again before it goes on. What constitutes a WXYZ combo? A WXYZ pattern is a complex ABC X ABC pattern where the initial ABC is labeled as a W, then the secondary ABC is labeled as a Y. So that is a combination of an ABC X ABC. So a double zigzag, a double flat, triple flat. So those complex kind of patterns that occur. Now we're not going to go that deep in it tonight, but basically when you see WXYZ, it's an ABC plus an ABC and possibly plus a third ABC, but rarely do you see a third ABC. So here's another running flat pattern. Again, at textbook 1, we've got an impulse up, down to the wave A, up to the wave B that makes a new high, impulse down to the wave C, just takes out the lows. Now notice in here we start seeing some high closes in the pattern and off we go to the upside. One of my favourite patterns is a triangle, and this is a classic Elliott wave triangle rather than a micro triangle that I talk about in adaptive analysis. Now the difference is that an Elliott wave triangle has 5 internal waves, and usually, and it may be on an intraday basis, that those internal waves all contain 3 waves each. So wave A, B, C, D, and E. The most important thing with a triangle, a standard triangle that is, rather than a running triangle, is that they must always coil. Wave B must be inside the prior high, wave C must be inside A, D must be inside B, and E must be inside C. Now the reason why there's such a powerful pattern, because at wave E you have a very, very low risk entry point, because you know as soon as the wave C level is broken, the pattern is validated and you will have a stop in place. So you place a stop a couple of cents below wave C and you try and buy wave E as it comes down into the dip here, and that's when you get your biggest bang for the buck. It offers a very, very low risk entry, and it's a high probability trade, especially when the prior impulse is very, very strong, and especially when you've got very well-defined coiling price action in 5 internal waves. Okay, very, very important. 4 internal waves, you may get a 3rd, or you may get the 5th, should I say, but when you get the 5, you've really got to go for it, because it offers up a very, very high risk reward opportunity. So you can see here we've got a nice impulse, A, B, C, D, and E. You see what I'm talking about? Now have a look down here at wave E. You have a stop just below the lows right here. You look to buy in this region right here with a very tight stop. It's a very low risk, high reward kind of trade. Absolutely a cracker kind of trade. So you can see in that particular example that it's all coiling backwards and forwards. It's all coiling. Each wave is inside the prior wave. Here's another example, and again the same thing stands. A, B, C, D, E. You see they're all inside one another. This one didn't give us the lowest kind of risk entry, but if you had a limit order to sell up in this region right here, then you could have ridden it right down. So it's a very, very good pattern to trade. The 5 internal swings. Whenever you see 5 internal swings in a triangle, I tell you, you've just got to take action with it. Question here, would you buy/sell when prices break above, below D in a triangle, or would you buy or sell at E? Well, the ideal situation, Brian, is to try and get your risk reward as low as possible, and in the ideal situation, you try and sell short right here near E, because you can place a stop up here at C. Now the other thing to do right here, and a lot of people look at trading in a very vanilla 2-dimensional way, but really we can take it to a 3rd dimension, and that is sell half of your position right here, get short right here on half of your position, then add as prices break out. And the reason being is because most people are waiting for the breakout through D to enter, and if people are doing that, they're going to be helping your position. So if you can already get onto your position and then add to your position when everyone else does, you're going to be pyramiding, and if you do get stopped out, well, you're only going to be stopped out on a small position rather than the full position. If we go back right here, okay, you can use the trader's trick entry right here. See that bar, wave E, buy on a break up through that high right there, place a stop 1 cent below that low, or if you want a little bit of safety, below wave C, and away you go. Very low risk entry. If it breaks up through wave D, you can add to the position straight away and get the stop up to break even. Very powerful position if you just want to think outside the box a little bit. So if you get the trader's trick entry opportunity, by all means take it. Sometimes that doesn't happen. On this particular example, that's not a good example to use the trader's trick, but an aggressive trader, and a lot of scalpers do this, they actually fade resistance. So they're looking at this little line through here, and you could fade that by putting a sell order, a limit sell order up around these levels up here, and hopefully you'll get tagged and the market will start moving away. The ideal position is to try and get snug as possible up to the wave C, because your tight stop enables a very, very low risk entry position. That's the ideal situation. Here's another one. A, B, C, D, and E, and look what's happened with wave E. We've swung down in a very high close, and you can see through here as well a couple of high closes. So it's the buyer demand coming in at these kinds of levels. And again, you can use the trader trick entry right here. All rules of Elliott wave have been met absolutely perfectly, and in you go with a nice low risk kind of entry. Here we have a summary of all our patterns side by side, so you get a bit of an idea of where we're at with them all. First and foremost, we've got the zigzag. You can see the deeper kind of pattern. The flat pattern tends to be a lot flatter, so you'll tend to have a zigzag in the wave 2 position. You'll tend to have a flat pattern in the wave 4 position. You will tend to have a running flat in either the wave 2 or 4. Sometimes it can be in the 2 position, and usually the triangle 99 times out of 100 will be in the wave 4 position. In fact, you cannot have a triangle in the wave 2 position. That is against the guidelines of Elliott wave. So if ever you see a triangle, you have to assume that it's actually in the wave 2 position, or it's a more complex pattern in a wave B position rather than inside an impulse. Okay, we're going to start talking about Fibonacci retracements. We're going to be talking about external and in alternate projections. This is where people can get caught up in analysis paralysis. Don't get too caught up on the measurements. At the end, I'm going to show you a summary of all the measurements, and I'm going to give you a spreadsheet that you can have a look at that has all those things on it. So Fibonacci retracements, external projections, and alternate projections as well. So let's start with retracements. At the Chartist, we only ever use 3 retracements. The retracements we use are a 38.2%, a 50%, and a 61.8%. That is it. We don't use anything more. A retracement is we have an impulsive move, and then we have a retracement back against that move of some degree. Usually in the wave 2 position, that degree of retracement will be quite deep, usually 61.8% or 50% to 61.8%. In a wave 4 position, it will be a lot more shallow because a lot more people are comfortable with the trend. They do not allow it to dip as far, and usually in the wave 4 position, the retracement will be 38.2% to 50%. In a downtrend, the same rules apply. So we have an impulsive move down, then we have a retracement back up, and then usually an impulse will follow that. And again, we use the same rules, 38.2%, 50%, and 61.8%. We do not deviate from those kinds of levels. And that's a good example of what we can expect in a retracement. So impulse retracement is the blue line, 50% and 61.8%. As I said, usually when the trend is very early on in the piece, we'll get a 61.8%. When the trend is mature, everyone's on board. They all understand what's going on. They understand it's an uptrend. It's not silly. And they will not allow the market to retrace as far as what the non-believers will allow back here in a wave 2 position. Now here's a good example of the kinds of retracements we can pull out of software. As you can see, they're completely and utterly useless. Everybody has their own. There are Gann retracements, there's harmonic retracements, there's Fibonacci retracements. I guess if you have enough retracements on the chart, you'll get it right, but at the end of the day, we simply don't know which one is going to stop. So we use very, very simple rules at the Chartist. In a wave 2 position, we always look for a retracement that's going to move 50% to 61.8%. That's it. Nothing else. It doesn't have to be spot on. It doesn't have to be perfect, but that's the kind of area we're looking for a wave 2 to terminate. In the wave 4 position, we're looking for a wave 4 to terminate in the 38.2% to the 50% zone, in that kind of area. And the justification is in a wave 2 it's deeper, in a wave 4 it's shallower. That's all there is to it. Let's talk about external projections. Now, we're not going to be projecting Fibonacci out of the correction. We're actually going to be projecting it inside the correction itself. So when I talk about that, basically what we're looking to do here is look for a terminal point of wave B. So we have an impulse up, we've got a wave A, we've got a wave B. Now what we're looking for is the correction down to wave C. So we measure the length of wave A, then we project it out from the wave B of that point. So usually that is a 1-to-1 ratio. Another way we can do it is we take this distance here and we project that out by a certain percentage as well. And what that will do is give us a cluster points down here. So just bear with me with this. We can take this distance down here and project it from the wave B high by a certain percent. Usually it's 1-to-1. Or we can take this distance and project it by this distance by a certain percentage, usually 50%, and we'll get a wave C terminal point. That is called an external projection. Now, an external projection is when we extend outside of the wave we're talking about. The wave we're talking about here is this wave A right here. We're extending outside of that. All right, not internally, we're extending outside of that. And that's why it's called an external projection. This is the other one. We take the length of wave A and we extend it out. Wave A, extend out, usually 50% or 100% off this wave B high. But that's an external projection. So we can extend it off the wave B or we can extend it off the end of wave A. The more we extend it off different points at different levels, the more of a cluster we're going to get down here. Now you can go to the nth degree. You can do it off here, you can do it off there, you can do it off wherever you want to do it off. But ultimately we're going to get a cluster point down here that's going to be the wave C. So an alternate projection is slightly different. We're actually taking the wave B, which is an internal movement. Here's the wave A, here's the wave B. That's internal. We're taking the distance of wave B and we're extending it outward again. And usually we'll extend it out by 1.5 to 1.618%, and that'll get us a wave C projection down here. So this is an alternate price projection. Alternate meaning that's an internal wave. We're extending it outwards from that internal wave. So really what I'm coming to here is we want to take a retracement Fibonacci level, an external projection, and an alternate projection, and what we finish up with is a cluster of projection points and retracement points, and that is the good point at which a wave C will tend to terminate at. So let's have a look in a more diagrammatic version here. So we've got this impulse and we're looking for a retracement of this impulse. This is the wave A and we're looking for what's called an external projection of that particular pattern or that movement downwards again. And here you can see this is an alternate projection. So this goes against the grain and we're looking for an extension downwards against that, the alternate. And what that will give us is a cluster point at this lower level down here. So impulse A, B, and C, this is what we're trying to figure out where the complete correction will terminate, and that will give us a good buying point. And the more of these projections and external retracements we can get, the better idea we can get at this point for a buying opportunity. So let's have a look here. We've got a 5-wave impulse off these February lows. 1, 2, 3, 4, 5. Up we go. Impulse to an A, up to a B. Now at this point right here we want to start asking the question, where will wave C terminate? So what I've done is I've color coded everything here. So on the green line going up with 61.8% retracement of the green line, okay? So that's a 61.8% retracement of the prior impulse. That comes in right there. The external projection is this move times 1.618. So this move multiplied by 1.618 subtracted from wave A takes us down here. And the alternate is this move here multiplied by 1.618 off that low gives us that low there. So you can see we've got this cluster down here and you see how it's all 61.8% levels. It's not an exact science to the cent, but you can see only one bar came into this real cluster zone before we started heading higher again. So A, B, C, here's our target area. Do we have a bullish bar at this point of time? Yes, we do. Do we have bullish volume at this point of time? Well, I haven't put it on this chart. Maybe we do, maybe we don't. Are there any other indicators right here that are saying that support is in at these levels and that a movement higher will occur? Well, I guess you can look across to the left here. We've got these old highs. Look at that. We've got 1, 2. We've got 2 old highs here, which is resistance back to support. Remember, old resistance becomes new support. So we're broken up, come back, bang, off we go again, and it just happens to fit into that cluster zone. Other question here is the purple external. The question is, was that from the top of wave B? No, it's not. It's an external projection, which means we've taken this line and projected at 1.618% straight down. So it's not from up there. That is usually a 100% projection. I haven't done it on this just to keep it clear. So we take this high, the wave A, and we project that distance off the wave A low by 1.618%, and we get that low right there. Just to reiterate that, we take this length, we multiply it by 1.618 and subtract it from that level, and that gives us that level right there. Remember also we can use the one-to-one, so we take this distance, subtract that distance exactly, and it will give us a measurement probably around this kind of area. That's the one we tend to use more often than not. Can retracements and projections surpass the 61.8 to get the cluster area, or is this the maximum? I'll come to that. I mean, there's lots of different measurements we tend to use, but usually we want to stick to the major ones, okay? The more you find yourself going out onto a limb, going, oh gosh, you know, that's a 78.6 and blah, 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 then the more you're pushing your luck. What you're trying to do in that situation is you're trying to fit the correction to what you want to happen. You understand what I'm saying? We don't want to push a pattern into the chart. We want the chart to tell us what the pattern is without trying to push a pattern onto it. It's very important to think about what is the chart telling us as opposed to, gee, what do I want the chart to tell me? Two very, very different things. And that's why we only ever use the very specific kinds of levels, i.e. the 61.8, the 50%, and the 38.2, and projections thereof. All right, so here's another one. We've got an ABC correction and a bigger corrective move. You can see this is bigger corrective move going up, so A, B, and C. So our retracement of the correction, so this move up here, all the way back down, that's 61.8%. The alternate price projection is 1.5%, so this movement up here, extended lower, is 1.5 or 50%. And then the movement down to wave A, external price projection is 38.2%. So we've got this cluster down here. Didn't quite get there, but look, a nice high close. Tag that zone, nice high close, and go straight off again. Remember what I said. When prices hit that zone, we've got to take note of what bar, what's happening. You can see here, very high close. Look at the bar before. Probe down, high close. Probe down again, and another high close. There's good buy demand coming in right here, and off we go straight up again. So it's hit the cluster zone. A little bit more complex kind of pattern here, without a doubt, but that's exactly what happens. And let's look at a bearish version here. So we go down at an impulse, A, B, C, back up, and a nice cluster zone here. So the retracement from this high, down, 50% retracement. The external retracement is exactly 1 for 1. That's what I'm talking about. So that distance added on to that gives you 1 to 1. Now that's the normal one we look at in the Chartist, okay? Where wave A equals wave C. We're looking for symmetry, wave C being the same length as wave A. And I'm sure if we did a external price extension, we'd get a 38.2% tag that area as well. So there's many ways you can do it, and the alternate is 1.382%. So we take this distance, multiply it out by 1.382%. So you will always get a cluster zone in this region, and the tighter it becomes, this cluster zone, the more positive one can get from the move lower. So here we've got a high close on that particular bar, but look at the next day, bang, low close. So that's your entry bar right there, selling a break of that low there, place a stop above that high, and away you go into the next trend lower. So that's a good ABC pattern in a downtrend. Here we have a flat pattern. Now the key thing with a flat pattern is wave C will always terminate at wave A, pretty well spot on, and that's what's happened right here. Not a good bar for that to occur. You can see we've got this big wide-ranging bar, but we even have some measured moves up and around this wave C area. The external price retracement is 1-to-1. That is, this wave right here is exactly the same length as that wave right there. And we also have a retracement of this move down, back up 50%. But the more important thing with the flat pattern is that wave C terminates at or near this kind of wave A high. The key element is this high has not been penetrated, so you would have been stopped out if you held on to a short position after entering on this bar right here. Time is an interesting one. It's something that we are trying to introduce a little bit more of. It can be very cumbersome unless you've got the software to calculate it for you. AmiBroker, and I will show you the AmiBroker software very shortly how it does it. There are a couple of other software packages that do it as well. Dynamic Trader by Robert Miner, which is, I don't have it, but Pete Hammersley, who does our ASX chart research, he uses Dynamic Trader. It does time projections very, very nicely. The Robert Miner book is a very, very good book for this kind of stuff. It's very practical, hands-on material, and I would strongly suggest that if you're interested in taking this further, that book is the way to go. Dynamic Trading by Robert Miner. He has 2 books out now. Dynamic Trading is his first book. It's a hardcover book. I haven't read his second one. I know Pete Hammersley has studied both of them in depth. So basically what we want to do is time is just a third dimension. We do not forego our Fibonacci retracements, our projections or our alternate projections, but we can add time in there as well. So if we have a look at this particular chart right here, we see an impulse down, we see a low point right here, and what we're doing is we're taking the time traveled from the absolute high to the absolute low of this impulse, and we're extending it out. And you can see right here that very, very close to a 50% extension, and we have a high point there at wave C. So A, B, and C. Remember, it's not an exact science. Don't get hung up on this exact science kind of stuff. A day here, a day there, but at the end of the day, you can see we've got some very good symmetry in this ABC from a price perspective, and we also have very, very good symmetry from a time perspective. And when it all meets up, again, it's just another level to be confident of to take a position. So we measure the move down in terms of business day, not in calendar days, and measure the move back up in business days, not in calendar days, and we get this time extension. All right, it's exactly the same, and again, we use the exact same measurements as we do for price retracements. So we're using 38.2%, we're using 50%, and we're using 61.8%. All right, they're the key 3 retracement levels in both time and price. Here's another one. We've got a move up, ABC, correction, and to the day, 61.8% in terms of time. Now, it'd be quite interesting to see how that extended out or that transformed in terms of price. It's a pretty shallow kind of correction. It looks like a 38.2%, but it would be quite interesting to see what the actual price retracements were on this, because the time projections are exactly spot on, and off we go again to the upside. And again, note this bar right here, you can see it behind the blue line, very high close. So again, just from a time perspective, very, very bullish signal right there. You could use the trader's trick entry, entering a buy above that high, and a stop loss below there gives you a very low risk entry, and off you go to the upside there. You take a low point, I take a high point and then the extended out by Fibonacci level. In fact, while we're on that, let me just bring up AMI Broker so I can show you. This is the XAO. So let's go back and find ourselves some kind of corrective movement. Here we go. Here's a nice... What pattern is this one, everybody? Got a high point, down, 3 waves up, and back again. That pattern right there is a running flat. See how wave B runs against that high, wave C runs below the wave A, and there we have a running flat. Now let's just have a look at a time projection. So when we're doing a time projection, we go Fibonacci, we go extensions, Fibonacci timeline. So there. Okay, so there's a 100% line, that thick line right there. We missed by about 5 days. It's a 100% line. So not too bad. Retracements. Now it looks like a 38.2% retracement. So again, we're going to take it off that low. So you can see here's our cluster right there. We've got a flat pattern. It's going to be a shallow pattern. There's our 38.2%. That's typical. Is our 100% time. Particularly, I mean, it's not too far out, but you can see what I'm talking about. You'll get a cluster in this particular point. Here's another running flat pattern. Let's have a look at that in terms of time. Insert Fibonacci time extensions. And okay, so what we've got is an impulse high A, B, C. We're out by just a couple of days right there. So that gives you a good idea. Let's insert the Fibonacci retracements. This one's going to be a little bit difficult. Okay, so that's a fair way out, that one right there. But in terms of our typical rules, you can see that the wave C has terminated just below the wave A, and that's the more important thing. And more importantly, notice that we've got a very high close in that particular point right there. So that's the more important pattern. So A, B, and C, where C terminates just below, we're at wave A low right there. Here's one here. Let's have a look at this one right here. So firstly, let's try the Fibonacci retracements off this low. Okay, so we've got an A, B, C. Look at that tag into 50%. Perfect. Now let's insert our Fibonacci time. So off the low to the high. Oh, look at that. Look at that. Let me just come across here. All right. Can everyone see that? So we've got impulse up, A, B, C is our 50% retracement in terms of price. And we're out by 1 day on our time. So the impulse up 100 and retracement down out by 1 day. So there's a good example of time and price relationship meeting pretty well perfectly. You're never going to get absolutely perfect, and if you look for perfect, you're going to be sitting here for a long time. And you can see prices just zipped on higher. So see that cluster right there? That's what I'm talking about, where price and time all meet at the exact same point, and away we go. There's your A, there's your B, and there's your C. Okay, simple as that. Impulse A, B, C, off we go. And remember, all our measurements are being met here. Remember, in a wave 2 position, we're looking for a retracement to the 50% to 61.8%, and there's the 50% tag exactly right there. We're going to be looking at volume. Now, volume we could spend 2 hours on its own. So what I want to do is just have a look at a few different things for you to keep an eye on. Now, the first thing I want you to understand is the volume histogram at the bottom of this particular chart. Some of you will be aware of this. This is something I've used for many, many years. Our black histogram is the volume. The red line is a 10-day moving average of volume. Okay, so that gives us the trend of volume. You can see here the trend of volume is increasing, decreasing and flat. increasing, decreasing. So the red line is a 10-day moving average of volume. The cyan line is a 2 standard deviation of the 20-day moving average of volume. Let me repeat that. The cyan line is the 2 standard deviation of 20-day average volume. What we're looking for in that particular situation is extreme volume. All right, extreme volume. Whenever we see a move of volume above that cyan line, we have to ask the question, what is happening here? What is going on? So what I want you to keep an eye out of here is what we call volume bubbles. That's when volume expands and contracts very, very quickly. And a lot of the time you will see volume bubbles occur at absolute low and high points. Have a look at this low down here. You can see volume expands and drops back down again. Volume expands and drops back down, expands and drops back down. But have a look where it's all occurred. It's all occurred more or less at the same price. And what's going on here is people, i.e. smart money, obviously think this particular stock is a pretty good buy at 30 bucks. And as I've said many, many times before with volume, the way these analysts work and the way these fund managers work and their analysts that work for fund managers, they'll say, you know, if stock XYZ gets down to around 30 bucks, it's a great fundamental buy. It's a good value proposition. They're not saying at 30 bucks exactly. They're saying if it gets around that level. And that's what happens right here. Prices come down, hits $30, and all these fund managers jump in and go, right, our analysts think it's a good buy in and around this place, and they start accumulating the stock down here. And that's why volume jumps, because these buyers come in and start accumulating the stock, goes up again, comes down, bang, in it comes again, we'll start accumulating, and one more time. They're not trying to pick the absolute low, they're trying to pick value. And that's exactly why these footprints are left in the volume. And this is very, very important to get a grasp of the volume, especially when we're talking about trying to determine the end of a correction move, because you will get these volume footsteps coming in and we will understand exactly when the correction will terminate. There's other ways we can do it using divergences and other kinds of patterns as well, but support, resistance and volume are very, very important in determining the ends of corrections. Here's another example right here. So we've got an A, B, C pattern. This follows on for an impulse, A, B, C. And have a look at this big volume spike down here, this bubble, volume bubble on this initial retracement. So buyers are coming in. Have a look, this bar right here, down, high close, another close off the lows. So there's buyers coming in. Volume is very high. Now have a look what happens. You can see volume drifts lower again as this secondary retest, which means there's certainly not a great deal of selling interest going on right here. But we're coming back into this area right here. Not a great deal of selling interest. In other words, the buyers don't have to do that much work again. So this is called a retest, and it potentially becomes a very, very bullish proposition when you see a retest on very, very low volume, which it is right here. You can see it's below average volume in these low points, and that just means there's absolutely no seller supply coming into the market, and that's a bullish proposition. Here's a triangle, and again it's very important to understand that during a triangle we've got 5 internal swing points. They must all coil as they do right here, and volume in general is drifting lower. But have a look at each one of the low points. Each one of the low points has an increase in volume, albeit for a day or so. So it looks like there's a line of support running through here at $50. And remember what I said, these analysts for the brokers will tend to say, oh yeah, stock XYZ is a good value buy at $50 or thereabouts. As soon as it pops down to $50, off they go and start accumulating thereabouts. But volume in general is declining in a triangle, and that's a very, very positive sign. And you can see prices started higher for a little bit but then failed. But ideally that is a perfect pattern, and volume contracting during that complete pattern, and that's very, very bullish. So let's just take a look at this. I've put a few more complex ones on here, but basically a wave 2, we're looking for 50% to 61.8% retracement of wave 1 and an outside chance of a 78.6% retracement of wave 1. In terms of time, a wave 2, a minimum time is 62% of wave 1 and the maximum time is 162% of wave 1. In terms of wave 4, we're looking for 100% of wave 2, 38.2% of wave 3 to 50% of wave 3, 38.2% of extension wave 1 through 3, and a 50% extension of waves 1 through 3. In terms of time, we're looking for a greater length of wave 2. It cannot be shorter than wave 2, and a maximum length cannot exceed wave 3. Now, this is already in the secure area. You can download it in the resource library whenever you like. Understand at the bottom here there's a bullish page and a bearish page. So if you're looking at a bullish impulse, you've got to go to the bullish page. If you're looking at a bearish impulse, you've got to go to the bearish page. One other thing, the time analysis does need an Excel input. You will have to use an add-in right here called the Analysis Toolpack add-in. If you do not have this Toolpack add-in, this time analysis will not work. This add-in is free. You can download it anytime you want. So you go Tools, Add-ins, click on Analysis Toolpack and go OK, and it will download it for you. What we want to do is let us assume that a particular stock has started an impulse. This is not trying to figure out where the impulse is going to start, what the start of the bull market is going to start. So let's just assume that it starts at $2, okay? And that's the base, that's the bottom of the impulse. And let's assume that wave 1 finishes at $3. So as soon as we put in wave 1, we know wave 1 is finished at $3 and there's some kind of decline going. You can see right here it's going to tell you exactly where wave 2 will terminate. In fact, it's telling you that wave 2 should terminate somewhere between $2.21 and $2.50. So it's working out the correction of wave 2. It's telling you look for a terminal point between $2.21 and $2.50. You can put in your dates in here. Let's just assume that this pattern started on the 1st of February 2011 and it stopped on the 25th of February 2011. So that's the length of wave 1. So it's telling you that the wave 2 will take between 12 and 31 days to decline. So let's assume that wave 2 actually stops at $2.35, just for argument's sake. Now what will happen, it's going to calculate where wave 3 will terminate. So it's saying that wave 3 will terminate between $3.97 and $4.05. That's the wave 3 termination point. So let's assume that wave 3 terminates at $4. It's then going to calculate wave 4 for you, and we come down here, it's saying wave 4 will terminate somewhere between $3 and $3.37. So let's assume wave 4 finishes at $3.25. It's then going to calculate the wave 5 target, which is $4.20 to $5.24. So you can see right there that it's actually counting out and telling you exactly when these waves will finish. So let's say wave 5 finishes at $5. It'll then start to calculate exactly when the bigger wave corrections will also start to unfold. So it's a handy little calculator to get a good idea of where these retracements and extensions of the bigger wave patterns can go to. And it's using all the measurements that are typical for time and price for Elliott wave. Now remember, these are taken from Robert Miner. I think he's one of the best at this business. So here's a question from Douglas. Time analysis using calendar days rather than trading days. No, it uses trading days. It does not use calendar days. And the term you need for that is called, you can see up here, network days. It will work out exactly any network days. It can actually work out holidays as well if you want to add in holidays as well, but network days is business days, not calendar days. So network days does that, and that's why you need the add-in. So that add-in that I talked about, that will enable you to use network days as an add-in. If you don't do that add-in, you can't use network days. So we are using business days, not calendar days. Question from Brian, does an irregular wave B projection mean a running flat or a flat? It means a running flat. It's an irregular pattern. Yeah, it's a running flat. That is basically a good little calculator to use. Remember, this is not an exact science. You still have to get a good entry set up when the time comes. But when all these things fit in, the time and the price all fit in the exact same point in a cluster, then you can gain some very, very good confidence that a position can be taken.